The Nasdaq is closed, and the last reported close for Opendoor Technologies Inc. Open on Friday, October 31st, 2025, was $7.77, marking a significant gain of plus 0.43 or plus 5.86% from its previous close. Now, you see that closing price, that 5+% daily pop, and the market narrative immediately begins to write itself. The iBuying model is finally working, the housing market is thawing, or perhaps it's just another meme stock surge that has little to do with fundamentals. That's the surface-level expectation, the story everyone is telling over their weekend coffee. However, the unexpected reality is that this recent volatility, while certainly magnified by retail sentiment, is underpinned by a subtle yet profound institutional shift that suggests a much deeper technical tug-of-war is taking place right beneath the surface. It is not just a surge of individual investors suddenly interested in real estate tech. It is a sophisticated battleground where long-term institutional conviction is quietly building, even as the core business model faces its existential crisis. This is the curiosity loop. The stock is behaving like a high-growth speculation play, but the movements are becoming less purely speculative and more indicative of smart money positioning ahead of a critical juncture. Deconstructing the narrative, macro versus micro. The general belief, particularly after the company's dramatic drawdown from its all-time highs, is that Opendoor is a binary bet on interest rates, a high beta proxy for the residential real estate market. The higher mortgage rates go, the more inventory risk it carries and the more costly its capital-intensive business model becomes. Conversely, any talk of Federal Reserve rate cuts, like the optimism we saw filtering into the market leading up to this recent close, acts like pure rocket fuel for the Opendoor stock, sending it soaring. The challenge to this narrative, the deeper reality, is that this stock's fate is now less about the macro rate cycle and more about operational execution and an emerging capital-light strategy that management is trying to implement. The market is giving management a final benefit of the doubt specifically around the potential for a coming earnings beat on November 6th, which will provide the true litmus test for their operational pivot. This recent momentum, then, is less an endorsement of the past 6 months of trading and more a sharp positioning for a potential surprise. Institutional investors, including a recently disclosed 5.9% stake by a major quantitative trading firm, are signaling that the short-term trend has shifted, and they are willing to stomach the volatility to be positioned for what they see as an asymmetric opportunity if the company demonstrates any meaningful path to sustainable gross margin improvement in the upcoming report. This is why the volume has been so exceptionally high. It's not just retail buying, it's significant, quiet block trading volume that suggests conviction is entering the play. This high volume, paired with a significant short interest that still lingers around 20% of the float, creates a tense environment ready for a short squeeze on any positive news, essentially baking in a technical catalyst to the fundamental narrative. Technical signals and analyst disconnect. When we look closer at the recent stock movement, the daily swings are instructive. From its low point earlier this year to the recent high just over $10 in mid-September, the stock has been extremely volatile, experiencing moves greater than 5% frequently. The strong close on Friday, October 31st for Opendoor stock at $7.77 was on elevated volume, suggesting a concerted effort to move the price higher, likely by those covering shorts or establishing long positions ahead of the earnings report. Crucially, the stock is currently trading well above both its 50-day and 200-day moving averages, which is a bullish technical signal that cuts against the historical financial skepticism. This strength, despite the overarching negative sentiment still reflected in the average analyst price target, which sits significantly below the current trading price, highlights the disconnection between the fundamental valuation models and the market's forward-looking pricing of a turnaround. The current market price seems to be assigning a non-zero value to the possibility of Opendoor becoming the last major iBuyer standing, capable of leveraging its scale, data, and technology to establish a defensible, profitable moat. The core business model and strategic pivot. The core business model of Opendoor Technologies Inc. is centered around iBuying, instant buying, which is fundamentally a market-making operation in residential real estate. They use proprietary pricing algorithms and data on millions of real estate transactions to make quick, all-cash offers to home sellers, aiming to provide speed and certainty that the traditional process cannot match. They take possession of the home, perform light repairs, and then resell it, generating revenue from the price difference, or spread, along with fees for ancillary services like title and escrow. The capital intensity is the major constraint. They have to tie up significant cash and debt to hold the inventory of homes, making them highly susceptible to rapid changes in local real estate values and interest rates, which affect their holding costs. Historically, this has led to massive losses, notably the period in late 2021 and 2022, when the sharp rise in rates caused them to sell inventory at significant discounts, leading to a precipitous drop in the Opendoor stock price. The recent pivot is an attempt to mitigate this through a capital-light approach, which includes new agent partnerships and a marketplace model that allows them to collect commission-like revenue without taking the full inventory risk onto their own balance sheet. This strategic shift is what institutions are quietly watching, as evidenced by the increase in certain institutional holdings despite a general de-risking from other large passive funds like Vanguard and BlackRock in the most recent filings. This tells a story of active, directional trading positioning versus passive investment flow. The path to profitability. Old reports versus new expectations. In terms of older reports, the company has consistently struggled with profitability, reporting cumulative losses since its public debut. However, the second quarter of 2025 delivered a notable achievement. The company reported a positive adjusted EBITDA for the first time since 2022. While this was a single quarter and came on the back of aggressive cost-cutting, it provided a glimpse of the model's potential operating leverage when market conditions and internal processes align. The market immediately priced in this possibility, creating the sharp rally we saw over the summer. The question now is whether the third quarter results due out soon can demonstrate that this operational efficiency is repeatable, especially heading into what is typically a slower seasonal period for real estate. This is the tension between expectation and reality. The market expects volatility and a continuation of the struggle. The reality that could send the stock soaring is a guidance beat that forecasts either a significant reduction in inventory risk or a meaningful expansion of the capital-light revenue streams. Future catalysts and major risks. Looking ahead, the future outlook for Opendoor Technologies Inc. is fraught with both existential risk and massive potential opportunity. The key catalysts are all tied to the successful execution of the pivot and the general direction of interest rates. Catalyst 1 is the upcoming earnings report. If Opendoor can show improved contribution margin per home and demonstrate that its risk management algorithms are successfully navigating the choppy waters of the current housing market, it will validate the operational turnaround thesis. Catalyst 2 is the continued rollout and adoption of the capital-light model. If they can meaningfully grow their non-inventory-based revenue, it de-risks the entire structure. Catalyst 3 is the broader macroeconomic environment. Any confirmed sustained signal of interest rate cuts from the Federal Reserve would be an immediate tailwind, decreasing their borrowing costs and increasing transactional volume in the housing market, which is Opendoor's lifeblood. This is one area where the company's prospects are intrinsically linked to the actions of the Federal Reserve and the broader economic health of the nation, something that can also affect giants like Apple stock or Nvidia stock as investors rotate across sectors based on monetary policy. The main risks are equally clear. The primary risk remains inventory risk. One wrong call on house prices, especially if we see an unexpected downturn, could force massive write-downs and push the company back into a cycle of large-scale losses. The second risk is competition and market adoption. While Zillow exited the pure iBuying space, traditional brokerages, including models similar to Fidelity Brokerage or other individual brokerage firms that are leveraging technology for client services, are not standing still. The company needs to prove its technology-driven value proposition is compelling enough to capture market share. The third risk is funding. While liquidity is currently strong, continued losses will